Revenue is healthy, sales are busy, yet cash and profit feel thin. That gap is rarely one big mistake, it's a handful of quiet margin leaks hiding inside everyday decisions, discounts that creep, products that sell but don't earn, service promises that balloon costs, and operations that slip 1% at a time. The stakes are real. A 2-point margin leak on $50 million equals a lost $1 million in profit. We'll use 4 practical tests to expose leaks using data you already have, starting with price realization. Where, precisely, is the money you thought you earned disappearing? To find leaks fast, anchor on simple margin math. Imagine a waterfall: revenue, less cost of goods, yields gross margin, subtract cost to serve and operating expenses to get operating margin. If your plan assumed 30% gross margin but actuals deliver 27%, that 3-point delta must be explained. Is it price not realized, a mix shift to lower margin items, unpriced service, or operational slippage raising unit cost? This baseline reframes the hunt from vague cost cutting to targeted diagnosis. Next, we'll assemble the data into a simple, reusable diagnostic framework. You need only 3 files to start: transaction-level sales with list price, invoice price, discounts, returns, freight and terms, item master with standard cost and product hierarchy, and basic ops KPIs like scrap, yield, and rework. Plot them into a margin leak map with 4 quadrants: price realization, mix shift, scope/service cost to serve, and operational slippage. Each test asks one question and quantifies a profit delta. Run weekly and trend over time. We'll start with price realization, the fastest way to find money left on the table without selling a single extra unit. Price realization asks, what did we actually keep per unit sold? The trap is assuming invoice price equals price. It doesn't. Realized or pocket price subtracts discounts, rebates, freight absorption, extended payment terms, cash discounts, damage allowances, and returns. 2 customers paying the same invoice price can yield different pocket prices due to terms or freight. Signals of leakage include widening variance between list and pocket price, discount outliers, and deals that only close at deep cuts. We'll build a pocket price waterfall to measure where each point of margin is leaking. Create a simple table by customer and product: list price, invoice price, less, on-invoice discounts, off-invoice rebates, freight absorbed, payment terms value, cash discount, returns/chargebacks, equals pocket price. Example, list $100, invoice $94, minus $3 discounts, $1 rebates, $2 freight, 50 cents terms, 50 cents cash disc, $1 returns equals $86 pocket price. With a $60 unit cost, margin is $26 or 30%, not the 34% you expected at invoice. Now sort by pocket margin, flag outliers, and compute the lift if each leak were trimmed by just 1 percentage point. Close leaks with rules, not one-off heroics. Add pricing fences, discounts only for qualifying segments or order sizes. Require give-gets, extended terms must pair with price uplift, reduced scope, or prepayment. Separate freight into pass-through line items where possible. Cap cumulative rebates and add clawbacks on shortfalls. Build an approval guardrail for deals below a pocket price floor, and nudge micro price increases on low-sensitivity SKUs first. Remeasure the pocket waterfall monthly. Next, we'll test whether the mix of what you sell, not the price, has quietly dragged margin down. Mix shift asks, did our volume tilt toward lower margin items, channels, or customers? You can grow revenue while shrinking profit if growth concentrates in thin margin SKUs or heavily serviced accounts. Use a price-volume mix, PVM, bridge, hold 2 factors constant while changing one to isolate effects. Price effect shows true pricing changes, volume effect reflects scale, mix effect captures composition. Many teams mislabel mix as price erosion. We'll run a PVM to separate them and see if your success is simply the wrong kind of success. Build a table by product family or channel. For each, note units, price, cost, and gross margin percent in period A and B. Compute price effect equals price, pricea, times units B. Volume effect equals units B, unitsa, times margina per unit. Mix effect equals total GM change minus price minus volume. Example, revenue up 5%, but mix shows minus 2 margin points because growth concentrated in entry SKUs at 18% margin while premium SKUs at 42% fell. That's not a pricing failure, it's a success allocation problem. Next, steer demand toward higher contribution mix. Turn mix from accident to strategy. Set contribution targets by channel. Distributors push high rotation core SKUs. Direct teams emphasize premium bundles. Rebalance price ladders to widen the value gap between entry and core. Add attach offers that pull buyers up one tier. Prune long-tail SKUs that consume capacity but add little margin. Route scarce capacity to high-margin orders first. Align sales incentives to margin-weighted revenue, not just top line. With Mix Guided, we'll test a quieter leak, unpriced service and scope creep raising cost to serve. Scope creep hides in kindness, custom packing, split shipments, rush handling, manual reports, engineering tweaks, endless support calls. Each feels small, but together they convert booked margin into untracked cost to serve. The test asks, after attributing service effort, which customers or orders are still profitable? We'll map major activities and assign time or transaction rates, pick/pack, expedite, special QA, tech support hours, returns handling. Then we'll build micro P&Ls that expose accounts earning 5% on paper but losing money after service costs. Implement a light time-driven activity-based costing. Define capacity cost rates, cost per pick, per line, per return, per support hour, per rush. For one customer, gross margin $200,000. Allocate service, 2,000 picks at $1.20, 800 lines at 70 cents, 120 rushes at $12, 90 support hours at $45, 30 returns at $18, custom pack at $0.40/unit. Total service cost $20,600 reduces true contribution to $179,400, about 10% erosion. Replicate across top 50 accounts to reveal negative contributors and high-friction orders. Next, turn those costs into explicit offers and rules. Convert freebies into a clear menu. Offer tiered service levels, standard, 2 to 3 day lead, consolidated ship, plus, next day, split ship allowance, premium, same day, dedicated support. Publish surcharges for rush, custom pack, and special documentation. Use SLAs and quoting templates so reps can say yes, at a price. Automate rejection of orders below minimum margin unless scope is reduced. Customers will self-select what they value. With scope contained, we'll probe the final leak, operational slippage, small efficiency dips that quietly inflate unit cost and compress margin. Operational slippage is death by 1,000 micro inefficiencies, yield down 1%, scrap up half a point, rework hours creeping, picking errors, machine downtime, or shrinkage. These rarely trigger alarms, but they raise unit cost and silently erase margin. The test asks, what small shifts in factory or fulfillment KPIs explain the gap between standard and actual cost? We'll focus on 3 indicators: first pass yield, E or throughput, and rework/scrap rates. Even modest deterioration can remove 1 to 2 points of gross margin without any change in price. Quantify the impact. Example, standard cost assumes 98% yield, last month was 96.8%. For a $60 standard unit cost, that 1.2% yield loss adds roughly 73 cents per unit after rework and scrap. On a $100 sale, gross margin drops 0.7 points. E from 72% to 68% increases over time and changeover losses, adding 40 cents per unit. Picking errors double from 0.6% to 1.2%, causing reships at $9 each across 2,000 orders equals $18,000, or another 0.2 points. Tie each KPI drift to dollars, then prioritize the top 2 drivers. Fix slippage with fast, boring discipline. Run a Pareto on defect codes and attack the top 2 causes. Standardize work for high-variance steps, use control charts with visual limits at the cell. Apply SIM to cut changeover time and free capacity. Schedule layered process audits to keep it sticky. Close the loop. When rework drops, update standard costs and return the saved margin to pricing and mix steering. Measured weekly, these small wins are compounding. Finally, let's stitch all 4 tests into a single, repeatable margin leak dashboard you can run every Monday. Build a one-page dashboard with 4 dials: price realization, pocket price versus invoice, mix shift, PVM, cost to serve, service dollars per order, and operational slippage, KPI to margin points. Each dial shows current value, weekly trend, and estimated margin impact. On Monday, export last week's data, run all 4 tests, and pick the top 3 actions: 1 pricing rule, 1 mix nudge, 1 service or ops fix. Review Friday. Over a quarter, capturing 2 points on $50 million turns into $1 million. Start this week, run the pocket price test and quantify your first win.